Superannuation is the large area of change from the budget, and there's 8 areas which I'm going to address here. First of all, there's a lifetime cap on non-concessional, being non-deductible contributions, and that cap's at $500,000. Many will remember that the situation was that you could claim $180,000 a year, and you could use 3 years limits within the 1 year. That's now all gone, and there's a lifetime limit of $500,000, and that's going to take into place any contributions that are made back to the 1st of July 2007. So that's a massive change. If you've already put in over that limit, there's nothing you have to do to undo it. It's okay. But for the others that have already used their limit, you can't contribute anything going forward. Point 2, tax-free pensions cap on 1.6 million. Again, this is a massive change for a lot of people with high-value superannuation funds. Previously, once you went into pension mode, you didn't pay any tax on your earnings, you didn't pay any capital gains tax on the earnings. Now there's this tax-free limit of 1.6 million per person. Above that, then the general rates of superannuation apply, that you pay 15% tax on the earnings, 10% on the capital gains. So again, it's still a better situation to have money in super than outside, where you would be paying marginal tax rates. However, it's not as good as it was. The obvious strategy for here is for couples to try and equalise their balance to make sure that they're getting 3.2 million as opposed to one person being over that threshold. Point 3 is transition to retirement pensions for those people who are still working and drawing money out of their superannuation account. This previously worked because you didn't pay tax on the earnings of the assets within superannuation. So from the 1st of July 2017, that's going to change and you will be paying tax. So for most people, you would have to consider undoing or ceasing that pension. It doesn't come into 1st of July 17, so over the next year it needs to be addressed as to whether you continue to keep going with that pension. Point 4, there's a contribution limit of $25,000 and you can have catch up on those contributions from prior years, which means that if in the previous years you were putting in $10,000 a year less than the maximum, so for the current year you could put in $25,000 plus 50, being 5 times 10,000. Point 5, contributions up to the age of 75 years. To do this previously, you had to pass the work test. The work test has now been abolished, so people can all contribute up until age 75. Point 6, employees can make deductible contributions. Prior to this change, employees had to salary sacrifice if they wished to increase their superannuation and make it tax effective. Now they can contribute to their super funds direct and receive a tax deduction. So it's the same overall tax effect as if they salary sacrificed. It's just quite easy to do now in that you just transfer the money from your own account and receive a tax deduction. Point 7 is 30% tax rate on contributions threshold, moving from 300,000 down to 250,000. So that basically means if you're earning over 250,000 taxable income, and that's including super contributions, you will pay 30% tax on your contributions rather than 15%. Previously that threshold was 300,000, so that's something that needs to be managed carefully. And finally, there are a couple of offsets for low income earners. If you're earning under $37,000, you can get a tax offset of up to $500 when you're making contributions to super. And for those whose spouse is earning under $37,000, you can contribute to them. So thank you for listening to the newsletter and appreciate the feedback as to whether you like this method of delivery.